Friends, thank you for being here today. If you have been meticulously tracking the financial press over the last 12 months, you have witnessed one of the most sophisticated narrative management campaigns in modern economic history. The story sold to the American public and the global investment community was one of unshakable resilience. We were told repeatedly that the U.S. economy was a juggernaut, that demand for American debt was purely organic, and that the escalating geopolitical tensions with the East were merely manageable risks, ripples on the surface of a deep and stable ocean. Before we proceed, I want to ask you, have you felt this disconnect between the headlines and your own economic reality over the past year? Pause for a second and let me know in the comments if the resilience narrative matched what you were seeing on the ground, or if the math just didn't add up for you. However, if we bypass the headlines and look directly at the raw ledger data, specifically the Treasury International Capital reports released recently, we see a reality that fundamentally challenges this official story. We are not witnessing a market that is purely resilient due to natural demand. We are witnessing a market that appears to be artificially supported by non-economic actors to offset a massive structural exit by its second largest creditor. We need to address the elephant in the room immediately. We are observing the hidden buyer phenomenon. The central question we must answer today is how the United States quietly absorbed. China, $688 billion exit from the Treasury market without triggering a systemic collapse. Before we deconstruct the mechanism of this absorption, one technical clarification is paramount. The Treasury International Capital data, which serves as our primary evidence, does not track intent. It tracks custody. It shows us where securities are physically held, not necessarily why they are held, nor who ultimately bears the economic risk of the underlying asset. This distinction is critical because it explains how large shifts in ownership can occur beneath the surface without immediate price discovery or public panic. It allows for a veil of opacity to exist between the true buyer and the market ticker. In previous analyses, we established the liquidation signal. We demonstrated using forensic data that China has strategically, methodically, and aggressively dumped massive amounts of US Treasury bonds. This appears to be far more than a standard portfolio rebalancing. The sheer scale suggests a coordinated geopolitical exit designed to sanitize their balance sheet for potential kinetic conflict. We know they sold to evade the kind of sanctions that froze Russia's assets in 2022, and we know what they bought instead, hard assets like gold, oil, and strategic metals. But that investigation left one massive, critical question unanswered. It is the question that many bond traders on Wall Street have been analyzing in private notes, but rarely address on live television. If the second largest creditor in the world, a nation that has underpinned the U.S. debt market for decades, dumped hundreds of billions of dollars of debt, why didn't the market crash? Let's look at the basic dynamics of supply and demand. The U.S. Treasury market is indeed the deepest, most liquid market on Earth, but it is not immune to volume shocks. When a massive seller floods the market with supply, prices typically succumb to downward pressure. When bond prices fall, yields and interest rates rise. If market forces were functioning without intervention, the exit of a player the size of China should have been a destabilizing event. Economic models suggest we might have seen the 10-year Treasury yield breach 6% or 7% during this liquidation window. Consequently, we could have seen mortgage rates spike into double digits, putting immense pressure on the U.S. housing market. We might have seen stress metrics flash red across the regional banking system, which is already managing hundreds of billions in unrealized losses on their hold-to-maturity books. Historically, comparable foreign selling events produced far sharper reactions. During Japan's reserve drawdowns in the late 1990s, Treasury yields moved violently. During China's 2015 reserve liquidation, yields spiked despite Federal Reserve accommodation. In March 2020, even modest selling pressure caused Treasury market dysfunction. By comparison, the relative calm during a near $600 billion to $700 billion liquidation stands out as a statistical anomaly. But the catastrophe scenario did not materialize. The yields rose, yes. They have been stubbornly high, but they didn't break the system. The auctions were sloppy. The tail was long, but the primary dealers absorbed the supply. The crisis was averted. The volatility was contained. Why? How did the U.S. Treasury market absorb a $600 billion selling wave without triggering a systemic event? The data suggests they didn't rely solely on the free market. A purely commercial market would likely have demanded a higher liquidity premium. Instead, the data indicates that a shadow network of proxy buyers stepped in to act as the Barnes, the bid of last resort. We need to advance our investigation from the seller, China, to the buyer. When we look at the flow of funds data, the buyer profile shifts dramatically. The debt that China dumped did not appear to go to mom and pop investors. It did not go to regional banks, who are currently capital constrained. It didn't even go to the Federal Reserve directly, as they are ostensibly maintaining quantitative tightening. So where did the bonds go? The flows point to two specific non-economic actors: the geopolitical proxies, essentially the allies, and the leveraged speculators, or the mercenary creditors. This appears to be a coordinated absorption operation. The U.S. financial system effectively swapped a hostile creditor, China, for captive creditors and tactical creditors. This kept the yields from exploding, but it has drastically altered the risk profile of the global financial system. We have moved from a market underpinned by global trade surpluses, stable, long-term money from nations that sell real goods, to a market underpinned by geopolitical alignment and leverage, unstable, short-term money. The debt hasn't disappeared. It hasn't been paid off. It has simply moved from strong hands, hands that held it for 30 years, to weak hands, hands that may fold at the first sign of volatility. To verify this, we look at the latest Treasury International Capital data from late 2025. The numbers are stark. China's holdings have hit a new low of $688.7 billion. This is down from a peak of over $1.3 trillion. That is a liquidation of roughly $600 billion. That is more than the GDP of Sweden or Poland pulled out of the US financing structure. This capital had to come from somewhere. Counterparties had to write the checks to provide China's exit liquidity. We identify the United Kingdom and Belgium as key players in this absorption. We noted their holdings spiked as China's fell, but identifying them is only the first step. We need to analyze the mechanism of that buy. It is not enough to observe the UK bought it. We have to ask, with what capital? If you look at the fiscal realities of these nations, the math requires explanation. This matters because the United Kingdom's financial system has recently demonstrated sensitivity to rate volatility. The 2022 liability-driven investment crisis exposed how quickly pension-linked leverage can destabilize gilt markets. In that context, absorbing large volumes of foreign sovereign debt is not a neutral portfolio choice. It introduces duration risk into an already fragile balance sheet. The United Kingdom is currently managing a twin deficit environment. It has a budget deficit and a trade deficit. This means the British government typically does not have a national savings account overflowing with excess dollars to recycle into US debt. Unlike China in the 2000s, which was earning billions of dollars a month selling manufactured goods, the UK is a net debtor in this context. So when the TIC report shows the UK holding nearly $878 billion in US Treasuries, surpassing China to become the number 2 foreign holder of US debt, we have to ask, who is the actual buyer? It isn't purely the British government. The United Kingdom line item in the data is largely a proxy for the City of London. London is the hub of the Eurodollar system, the offshore banking network where US dollars are created, lent, and traded. The Eurodollar system operates outside direct US regulatory oversight, allowing dollar liabilities to expand through bank balance sheets rather than central bank reserves. The system provides flexibility in absorbing treasury supply, but it also concentrates risk within leveraged intermediaries rather than long-term sovereign holders. The surge in UK holdings likely represents a massive mobilization of Western banking capital. It suggests that transatlantic banking giants may have acted as market makers to absorb the supply coming out of Asia. These institutions effectively warehoused the debt. They took the paper off China's hands, preventing a liquidity crisis. This activity often aligns with central bank liquidity provisions, ensuring that if market makers face stress, backstops are available. Then we look at Belgium. Belgium's recorded holdings sit at nearly $470 billion. Let's pause and consider the scale. Belgium has a GDP of roughly $600 billion. It is structurally unlikely for the Belgian government to hold nearly 80% of its GDP in US Treasuries as a sovereign reserve. So why is Belgium showing these inflows? Because Belgium is the home of Euroclear. Euroclear is one of the world's largest international central securities depositories. It is the plumbing where securities are held in custody for third parties. In custody-based systems, ownership visibility is intentionally obscured. Sovereign funds, central banks, and large institutions routinely route holdings through custodians to avoid signaling exposure. This does not imply nefarious secrecy. It reflects standard risk management during periods of market stress. When you see Belgium buying in the report, it is rarely the Belgian state. It is a custodial mask. But here is the critical inference. Market analysts suggest that official sovereign wealth funds from allied neutral nations may be routing purchases through Euroclear to maintain anonymity. Why would they do this? Because periods of stress often trigger coordinated policy responses. When a major creditor dumps, Treasury officials historically coordinate with allied finance ministries to manage the fallout. Liquidity is needed. Stability is paramount. This amounts to strategic capital alignment. The G7 and its orbit of allies appear to be utilizing their liquidity to plug the hole left by Beijing. They are allocating capital to US deficit financing at a time when domestic priorities are competing for resources. But here is the risk in this arrangement. These proxy buyers may not be price insensitive. China bought US debt because they required it to peg the yuan and recycle a surplus. They held it for decades. They were a sticky buyer. The UK banks and Euroclear proxies are buying it potentially as a policy response or a short-term store of collateral. They are renters of the debt, not necessarily owners. If the UK economy faces headwinds, which remains a risk given volatility in the gilt market, these entities may be compelled to sell. They would need the liquidity for domestic stability. And because they now hold nearly $1.3 trillion combined, their potential selling could be more volatile than China's. China exited strategically over years. Financial proxies can exit in weeks. We have replaced a strategic rival, China, with a complex web of allied proxies. We have traded a political risk for a structural solvency risk. I want to pause here and pose a question to the room. Do you believe these allied nations are absorbing this debt out of pure economic self-interest? Or do you see this as a form of financial vassalage, where they are being strong-armed into backstopping the dollar? I'm very curious to read your theories in the comments below. But the proxies are only half the story. The other half of China's debt didn't go to a government. It didn't go to a sovereign wealth fund. It went to a jurisdiction known for opacity. And this is where the real systemic risk lies, the leverage risk that could amplify volatility overnight. If you scan further down the Treasury International Capital Report, past China, past Japan, past the UK, you will find a line item that demands scrutiny: the Cayman Islands. This jurisdiction is now listed as holding over $418 billion in US Treasury debt. Obviously, the local economy isn't buying $500 billion of government bonds. This is hedge fund capital, and specifically, this is the footprint of one of the most leveraged trades in modern finance, the Treasury basis trade. The Cayman Islands appear frequently in global capital flow data because they serve as a legal domicile for international hedge funds. Their presence reflects regulatory structure, not domestic economic activity. And when Cayman holdings rise, it typically signals leveraged strategy deployment rather than sovereign reserve accumulation. But here's the critical detail. The official number, $418 billion, is likely an undercount. Research from the Federal Reserve suggests that the actual exposure of Cayman-domiciled hedge funds is closer to $1.85 trillion. There is a massive blind spot in the standard reporting. Why the discrepancy? Because the TIC report counts long positions held in custody. It doesn't fully capture the leverage. It doesn't capture the fact that these hedge funds aren't just buying the bonds. They're using them as collateral in the repo market to borrow massive amounts of cash. Here's how the hidden buyer likely absorbed China's exit, utilizing a mechanism known as the spread. When massive supply hits the market, the price of the cash bond falls slightly below the price of the Treasury future. This creates a pricing inefficiency. Hedge funds step in. They buy the cheap cash bond, the supply China is shedding, and simultaneously sell the expensive future. They lock in the difference, the basis. Because the profit on this trade is often just basis points, they utilize significant leverage. They take the bond, pledge it as collateral in the repo market, and borrow cash to buy another bond. They repeat this cycle. Industry estimates suggest leverage ratios can reach 50-to-1 in extreme cases. The structure functions smoothly only when funding markets remain calm. Small changes in repo rates or margin requirements can force rapid deleveraging because the profitability of the trade depends on continuous access to cheap overnight funding. Do you see the structural transformation? China held the debt with cash. They owned it. It was a one-to-one position. It was stable. The hedge funds hold the debt with leverage. They own it with borrowed money. It is a highly leveraged position. It is sensitive to funding costs. The US government has effectively allowed a portion of the national debt to be absorbed by arbitrage strategies. These hedge funds are mercenary creditors. They are market-neutral profit seekers. They do not hold for geopolitical stability. They do not hold for the long-term health of the dollar. They hold based on the repo rate. As long as they can borrow cheap cash overnight in the repo market, the trade works. But what happens if interest rates spike? What happens if the repo market tightens? What happens if bank balance sheets contract? The hedge funds face a margin call. And unlike a sovereign nation that sells over years, leveraged funds must sell immediately. If they get a margin call, they must liquidate positions rapidly to cover their loans. They become forced sellers. This is the liquidity event scenario. We are sitting on a complex web of obligations. China has handed the inventory to a group of investors who have a history of volatility. We saw this in March 2020. In March 2020, this exact trade unwound. Hedge funds sold treasuries into a falling market, and liquidity evaporated. The Federal Reserve had to intervene with trillions to stabilize the system. At that time, bid-ask spreads widened dramatically, dealers hit balance sheet limits, and treasuries briefly failed to function as liquid collateral. The response required direct Federal Reserve intervention as the buyer of last resort. underscoring the vulnerability of leveraged Treasury demand. Now, the gross exposure is larger. The blind spot is significant. The hidden buyer has stabilized the market for now. They absorbed the China supply, but they have introduced a layer of leverage into the US Treasury market that relies on calm funding markets to survive. We have identified the buyers. The mystery of the China gap appears solved. It wasn't magic. It wasn't purely organic demand. The data indicates it was filled by political proxies like the UK and Belgium and leveraged speculators in the Cayman Islands. The conclusion is defensible. The quality of the US creditor base has shifted. We have moved from strong hands, sovereign nations with trade surpluses, to weak hands, leveraged speculators and proxy states. But this shift in ownership compels us to ask a deeper, more uncomfortable question. Why is this happening now, and what does the endgame actually look like? To fully grasp the magnitude of this shift, we must look beyond the mechanics of the trade and understand the strategic intent of the seller. China is not merely rebalancing a portfolio. They are engaging in a definitive defensive decoupling. Following the freezing of $300 billion in Russian central bank assets in 2022, the message to Beijing was unambiguous. US Treasuries are no longer a risk-free store of value. They are a political lever that can be deactivated at the whim of Washington. For a nation preparing for the possibility of kinetic conflict over Taiwan, holding $1 trillion in an asset class that your adversary can vaporize is not just negligence, it is strategic suicide. China's exit is not a retreat, it is a rotation. They are moving from a store of value, paper debt, to a store of utility, commodities. They are buying gold, copper, and energy reserves. They are effectively forcing the U.S. to finance its own deficits or rely on its allies, knowing that this places immense strain on the Western financial architecture. By withdrawing their real capital, surplus generated from manufacturing, and forcing the West to replace it with financial capital, leverage generated from banking, they are accelerating the fragility of the dollar system. They are betting that the U.S. cannot maintain interest rates high enough to attract capital without crushing its own economy. And they are removing their subsidy, the recycling of trade dollars, precisely when the U.S. needs it most. And what of the allies? The burden on the UK, Europe, and Japan to absorb this debt is not without cost. This phenomenon is arguably a form of financial vassalage. By purchasing U.S. debt during a period of dollar strength, these nations are essentially importing U.S. inflation. They are degrading their own currency's purchasing power to maintain the liquidity of the imperial center. This creates a dangerous divergence between their domestic economic needs, which may require lower rates or local investment, and their geopolitical obligations to buy treasuries. How long can the City of London or Euroclear act as the warehouse for American debt before their own bond markets revolt? We saw the cracks in the UK gilt market in 2022. The tighter the correlation becomes between U.S. volatility and Allied stability. The contagion channels are being widened, not closed. Furthermore, we must scrutinize the durability of the basis trade salvation. This is not a structural solution. It is a regulatory arbitrage. It exists only because post-2008 banking regulations, Basel III, made it expensive for large banks to hold treasuries on their balance sheets, forcing them to offload this role to unregulated hedge funds. We have effectively privatized the liquidity of the world's reserve currency to entities that have no mandate to maintain stability. Their only mandate is profit. If the trade turns unprofitable, due to a spike in repo rates or a regulatory crackdown, liquidity vanishes instantly. This leads us to the inevitable endgame: fiscal dominance and yield curve control, YCC. If the hidden buyers, the allies and the speculators, reach their saturation point or are forced to liquidate, who is left? There is only one buyer of last resort: the Federal Reserve. If the private market refuses to fund the U.S. deficit at politically acceptable interest rates, the Fed will be forced to transition from a monetary dominance regime, where they fight inflation, to a fiscal dominance regime, where they must fund the government. This would likely manifest as yield curve control, similar to the Bank of Japan's policy, where the central bank pledges to buy unlimited bonds to cap yields. But here's the catch. In a YCC scenario, the bond market ceases to be a market. It becomes a utility. And if you fix the price of the bond, the volatility doesn't disappear. It transfers to the currency. If the Fed has to print trillions to buy the debt that China, the UK, and the hedge funds are selling, the supply of dollars expands rapidly against a fixed supply of goods. This is the doom loop. The defense of the bond market ultimately requires the sacrifice of the dollar's purchasing power. This is the macro context in which you are operating. The hidden buyer has bought the U.S. time, but they have not bought a solution. They have simply compressed the spring of volatility tighter. When that spring releases, it will likely not manifest as a simple stock market correction, but as a currency event, a rapid repricing of the dollar against real assets. Given this landscape, the logical question for any astute observer is, how do you position yourself against a system held together by leverage? How do you protect your wealth when the mercenary creditors potentially rush for the exits? We can distill this into a clear, actionable protocol. The first step is to avoid the blast radius of the basis trade. The pilot of the basis trade has historically unwound during periods of high volatility. When it unwinds, liquidity often evaporates. The bid can disappear. Therefore, do not rely on being able to sell assets easily during a crash. You must maintain a liquidity buffer. Keep a significant portion of your portfolio in cash equivalents, specifically short-term T-bills with 1 month to 3 month duration. Crucially, hold these directly via a Treasury direct or brokerage account, not in a bond fund that might gate withdrawals during a panic. You want the asset that is the collateral itself, not a claim on a fund that holds the collateral. Cash is your oxygen mask. When the basis trade breaks, institutions scramble for cash. You want to already have it. Bond funds, by contrast, introduce redemption risk. During periods of stress, they may suspend withdrawals or sell assets into illiquid markets, amplifying losses. Direct ownership avoids this layer of structural exposure. Beyond liquidity, you need a warning system. The canary in the coal mine for this entire structure is the Secured Overnight Financing Rate, or SOFR. This is the interest rate that hedge funds pay to borrow cash overnight. Normally, it tracks the Federal Reserve's target rate closely, but if you see the SOFR spike significantly above the Fed funds rate, even by a seemingly small margin like 0.05% or 0.10%, it indicates plumbing stress. It means the banks are restricting lending to the hedge funds. It means the leverage is becoming expensive. That is your signal. When repo spikes, deleveraging often follows. The moment you see stress in the repo market, you must go risk off. Exit risk assets, stocks, credit, and long-term bonds immediately. We observed this in September 2019 and March 2020. History offers a template. Watch the SOFR. Finally, let's look at the trade one last time to understand the ultimate hedge. China sold bonds and bought gold. Hedge funds borrowed cash and bought bonds. China is holding the asset, the metal. The hedge funds are holding the liability, the paper wrapped in more liability, debt. In a deleveraging event, paper assets face pressure. Hard assets tend to outperform. Align your long-term savings with the entity that is buying the hard asset, the sovereign, not the entity that is arbitrating the spread, the speculator. Accumulate physical gold. When the basis trade unwinds, central banks are often compelled to intervene with liquidity. The liquidity injection can devalue the currency and send gold higher. Gold is the only asset that has no counterparty leverage risk. It is the only asset that does not depend on the repo market to function. Let the hedge funds pick up the pennies in front of the steamroller. You stand on the sidewalk with the gold. I'm curious to gauge the sentiment of this room. Do you agree that hard assets are the only true hedge against this fiscal dominance? Aye, or do you believe the Fed can engineer a soft landing without debasing the currency? Sound off in the comments. I read them to see where the smart money is actually positioning. Ultimately, the United States didn't solve the China problem. They managed it. The data suggests they moved nearly $700 billion of supply into the Cayman Islands and the City of London. The debt is still there. It hasn't vanished, but now it is held by entities that may sell at the first sign of trouble. The system appears more fragile today than it was when China held the debt. The buffer is gone. The leverage is high. What has changed is not the quantity of debt, but the quality of its holders. Stability has been preserved by shifting risk, not removing it. Over time, systems built on leverage and coordination become less resilient, not more. Tread carefully.